talking about what to do when interest rates fall today, and we have had interest rates fall in the last week or so. We've seen the cash rate cut recently to 1.25%. What does that mean for the economy?
I don't think anything good ever comes from cutting interest rates, depending on which side of the fence that you're on. Obviously, if you have a mortgage on your home and the interest cost comes down, then obviously that's good for you. And there's some things that you can do to try and make the most of that opportunity. But it really then is an indication of how tough things are out there. The retail environment is very tough. Employment, wages, growth. When we're talking about the economy as a whole, and this is reflective of what's happening overseas at the moment, it's always a bit of a balancing act between managing interest rates to try and curb growth and inflation, but also then saying, well, we need the economy to be bubbling along and we need people spending money. And some of the key indicators there are obviously that we have a very indebted population. We've also seen money be very, very cheap compared to historical levels, and certain generations and their belief systems have seen that as an opportunity to become heavily leveraged, which, like most things in life, comes home to roost when interest rates start to move up. So it's a tough position to be in. And
yes, so you mentioned consumer spending. You mentioned consumer spending is down, and that's a fact, obviously. Yeah. But the government would have to say that the economy is really looking good because we've got confidence in the economy. I suppose with the difference of being down and having confidence in it is two different things. Yeah. But what about the ScoMo effect that they talk about so often, with the change of with the government being re-elected, taking away a lot of that doubt? What's your take on it?
I think we've seen some indicators in the market, especially post the election, where there was a lot of fear and contention over the proposal of the loss of franking credits for retired members of the public.
Which that would come right into your bailiwick there.
Do you know what? I've had a box of Kleenex on my desk for the last 3 months. And I'll tell you, it's had an absolute battering. So, I was thinking at one point I'm going to have to start recommending Kleenex shares. But, that effect has really seen the banking sector and the yield sector rally off the back of not a lot of change. And I think people need to be mindful of the fact that growing is good, as when we talk equities now. Making money and things growing need to be underpinned by earnings. I think what we've seen in equity markets over the last couple of months is the speculation taking over. And what I mean by that is when we see a cut in interest rates, people that have retired or have cash and term deposits to try and underpin lifestyle, you're not earning as much as you were. So in some situations, you're forced to then look at other alternatives such as property, Australian shares, and that's where the franking discussions really come in, because the rate of return from, for example, bank stocks is definitely something that we have to worry about, and it's going to impact the way that people look at different investments.
Okay, we'll take a little break and then we'll come back. It's 23 minutes to 5 and we're talking finance, and we're talking with Luke Smith from Envision Finance, and we were talking about equities.
Yeah, that's right. And I guess what I was touching on before the break was where we see interest rates fall, people are forced to then look for other income streams. And whether that's property, whether that's Australian equities and things like that, we've seen this need for income as a reaction to interest rate cuts push the price of equities past potentially what some things are worth when you consider fair value. So I think people need to be mindful of the fact that if we think back before the GFC, we're only about 4% from the all-time high of Australian equity markets. So, whilst the GFC of 08-09 was 10 years ago,
we're that close to it.
I read it.
That's scarily close.
Well, exactly. And this then comes back to saying, in a relatively poor economic environment, what's going to be the stimulus to try and increase earnings when, for example, bank stocks have a lot of headwinds in relation to interest rates, borrowing percentages, the serviceability issues that they've had in relation to taking out new money, the lens that they've used to look at for people to take out new loans. They all start to put pressure on their ability to make the profits that they've made. And I guess people should be mindful of that and not just race out and buy dividend-based stocks just for the income stream, because whilst they want to earn more than 1.25% with their dividends, if we saw a 15 or 20% correction, it could actually make a significant impact on the capital price of their broader portfolio of the assets that they generate their income from. So it's
Should people be worried? I mean,
look, I wouldn't be worried about it, but I think I'd be going into something with my eyes wide open.
Yeah.
I'm quite happy to say I've been holding a lot of cash because I think if you look at where things are, a good indicator for me is the 10-year bond rate. So prior to last week when they cut rates from 1.5 to 1.2%, the bond market said that they priced a 10-year bond in Australia at 1.5%. So you give your money to the Australian government and they give you back 1.5% in 10 years. Now, when that's equal to the at-call cash rate, that doesn't paint a very good picture going forwards. But I think people need to be mindful that economically it's not all cupcakes and rainbows at the moment.
Okay, getting back to the rate cut, how does it actually impact?
Well, look, I think people need to be on the ball here, and they can make a lot of good decisions to try and make sure that they make the most of an interest rate saving. So, maximising their loan repayments is very good because any time you can pay off debt at a low interest rate, you can make some real inroads into the debt that you carry. I also recommend that people look at the rate that they have. So, they should be shopping around, they should be going to a mortgage broker, they should be getting some proactive advice to see what they're paying and what they could be paying, because if you can save 50, 60, 70, 80, $100 a month, you carry that forward, that can make a significant impact into the amount of debt that you carry. I wouldn't be locking in term deposits for an extended period of time because the duration between 6 months and 5 years, the fact that it's locked up for an extended period of time, you're not being rewarded in the current environment with a significant increase in the rate of return. So if we said 3 months is 1.5% and 2 years is 1.85, it's really not worth losing the access to that money. So I think people need to then start to look at where they hold their cash, pay off as much as you can, get as much into an offset account as possible at the moment to try and make sure that you're paying down the liability that you have while still maintaining access. And we've talked about the use of offset accounts in other shows because they're a very flexible vehicle to make the most of things. At this time of year, it's also very beneficial to be looking at potentially drawing pension payments from super to pay down debt. So if you have liabilities and you can access tax-free money out of your pension account, extinguishing debt in a low interest rate environment can also be very beneficial, provided that you're in that age bracket and have that flexibility.
So sometimes it's easier said than done when you come to touch your super, isn't it?
Yeah, correct. And obviously, you need to have met your preservation age. You've met a condition of release where you've declared that you've retired and you have that income stream in place. But coming into 30 June, it's a very good way to use that as part of broader strategies for making deductible contributions to help your tax, but also then to look at paying down debt and building up money in an offset account. And I think people should also be mindful of budgeting. I think it's one of those things that is underutilised and underrated. But sharpening up your budget and knowing where your money's going gives you the ability to pay down more potential debt in a lower interest rate environment, which you'll pay off more sooner and faster by having good, consistent budgeting behaviour. So I think there's some key things that people can make the most of a rate cut. I'd be disinclined, given the general percentage of people's home to debt ratios, to then say, oh, well, we saved $100 a month on a mortgage, let's go and get a new car, let's go and burn it, let's go and use it for discretionary spending. I think this is one of those times that, whilst it sounds rather boring, and it might actually make me feel a little old, making the most of paying down debt in a low interest rate environment is very beneficial for people, because they'll get a lot further forward than they would if we saw rates rise now. I'm not saying they will anytime soon, but this is an extended period. No, and this is an extended period where good, consistent behaviour can really stand you in a good stead in the future and give you other options and other choices where you have less debt to service.
A lot of people have this mantra, if you're not happy with your bank, shop around and get another one.
Yeah.
Sometimes that's easier said than done, because by the time we change banks, change forms, there's a lot of rigmarole to do with it, I believe.
Correct. Yeah.
But Then of course, when they got the rate cut, some banks, or one bank in particular, was a little bit reluctant to pass it on in full.
Exactly, and that's where I think people need to be proactive. They need to be looking at what their rate is. They need to look at what their provider has done for them. And I'd be looking at big bank, small bank, and this is where going out and getting a mortgage broker and having them do all of that legwork and drawing on their experience in relation to rates, interest rate, what they pass on, and the structure of loans can really add some value to your cash flow, the payments that you make, and the rates that you incur. So I'd recommend that anybody be shopping around and be proactive. But I also would say that getting advice from a good mortgage broker is invaluable, because they can take away a lot of the angst that you talked about, because it can be rather onerous. And I'm yet to find another bank ring me up and tell me about someone else's deal. It's never happened to me.
True.
I bank with two banks, and we'll change the names to protect the innocent.
Yeah.
But Bank A and Bank B have never rung me and said, hey, Bank C have got a great deal going on. So that's where a mortgage broker can really add some value and make the most of your cash flow, because the structure of your loan is something that you should be reviewing. So if you borrowed a lot of money and you've paid that down, and you have a loan on, say, principal interest terms, restructuring that loan could actually bring your minimum payment down, which could help bolster your personal cash flow. You're still paying off the debt, but it's something that people need to be mindful of, because it's not a set and forget world we live in anymore. You need to be on top of these things. You need to be looking at your budget. You need to be looking at your costs and your expenses and making the most of these opportunities, because a few basis points here and there can really start to add up with some significant borrowings.
Yeah, well, as you say about getting into a mortgage broker and things like that, you don't know what you don't know,
as someone famously said, exactly right. So I'd recommend people do that.
I think mortgage brokers could have been an endangered species if they hadn't been a change of
well,
if there had been a change of
and look, there's another wonderfully disconnected piece of legislation that doesn't value the job that they do, because a good broker is worth their weight in gold. So look, if you don't have one and you want one, give us a call in the office. We can put you in touch with 2 or 3 different brokers that we use that can take the angst away from this and make sure you're not paying overs, because it is something that is really important.
Okay, we're talking finance with Luke Smith from Envision Finance. Luke, with rates going down, what can people do to maximise their income stream?
Yeah, look, so I think this comes back to some of the key points we talked about earlier in the show, that you really need to look at options to fund your lifestyle, especially for those that have retired. Depending on your risk profile, obviously, that will determine your appetite for this type of investments that you're happy to hold. And I think where you're going to step out of cash to try and earn some more money, I think people should be looking very seriously at the fixed interest sector, because a lot of people come in the office, and I found it quite interesting during these last few months where there's been some unknown about the election and what will happen to income and franking credits. People hear fixed interest, they think term deposit, which is quite interesting, because for somebody that talks about different sectors with a fair bit of detail and tries to explain things to people, I've found that I use the word fixed interest and the people across the table hear term deposit.
Term deposit, yeah.
When in actual fact, fixed interest, like any other sector, has the ability to go up and down in value. It can be forward-looking instead of backwards-looking. And if you think about a term deposit is backward-looking in a way, because it says, what's the rate we're going to give today, given what we know? Whereas fixed interest assets are actually proactive and say, if rates go up and down in the future, can we make money from a change that could actually add capital value to our portfolio whilst giving us an increased rate of dividend income? So people should look at fixed interest opportunities. They should look at where the fixed interest is invested. So you could have some in domestic assets. You could have some in offshore fixed interest, because our fixed interest market and the US fixed interest market are two very different animals, two different economies in two different time frames that are going through two different cycles that could provide an increased rate of return. So diversifying your fixed interest is important, just like you diversify your broader portfolio and not have all of your eggs in one basket.
Yeah, I was going to say eggs in one basket versus spreading it out as much as you can.
Yeah. Look, exactly, and fixed interest. Fixed interest is no different. Look for good recurring income streams. Look for different rates of return. look for different time frames or the duration of how long things are invested for. Look at the way that money's paid. Some funds will pay monthly, some funds will pay annually. So find an investment that suits your cash flow and try and tie those two together so that you've got good liquidity.
A lot of people see investment as property.
Yep.
Property, definitely property, and
Yep.
you know, when you say pay off debt, what do you look at here? Increasing the net rent?
Yeah, look, exactly. Yeah, look, exactly right. I think where people turn around and say, well, say I've got some money sitting in a bank. If you were to use an offset account and pay down or offset some of the loan that you have on an investment property, that may allow you to take a property from being neutrally cash flow, i.e. interest is the same as rent, to actually then have positive cash flow, where you would be able to add that to salary, wages, or income from other sources such as term deposits, equities, superannuation, pensions. So that's exactly right. Paying down some of that debt allows you to generate an increased yield from your assets. And again, that ties into what sort of interest am I incurring. If you can sharpen that pencil, you may be able to then find additional positive cash flow out of an investment property.
Okay, that takes us on to, if people are maintaining home loans and investment debts, what are some of the things they should be considering as we speak?
Yeah, so again, check your rates, check your provider, and consider some of the smaller lenders. You know, the big four are the big four, but we're talking about a highly competitive market that is extremely well regulated. So whether it's a smaller lender, do your homework, have a mortgage broker crunch some numbers for you, because we've had clients go and see brokers and, you know, we're talking 0.5% difference. So that starts to add up on significant borrowings. Look at the structure of the loan. Do I have interest only? Do I have principal and interest? Because those two loans will again impact your cash flow, and they will have different repayment structures. So if you do have a lot of cash sitting around, interest only may be appropriate, because you only incur the interest cost on what's outstanding. So if you're a good saver and you can pay that down, that will help you reduce your payments over time. Look at variable versus fixed. Now, that for me is an age-old question. Do I fix, do I not? And depending on the time frame that you cut that up,
specialist or an expert to determine that.
Oh, look, and that's why, you know, going to a mortgage broker, they can show you the history of these things. They can show you where you win and where you lose. For me, fixing a loan is about security. You're never going to get it right. You're never going to get it wrong. Rates may go up, rates may go down. You may fix for 3 years. You may fix for 5. But at the end of the day, you need to be able to look in the mirror and say, am I comfortable controlling my expenses at this level? If your answer to that question is yes, then fixing a part of your loan may be appropriate. I'd always say, think about fixing part and not all, because if you did change your cash flow situation, inherit some money, have a bonus, and you can pay down part of it, where something is fixed, you have limited ability to put additional money on that liability or on that loan. So think about how that's structured. Check with your bank and see what they've passed on, as we said earlier. Not all banks have passed on at the same rate.
That's right.
So if you can,
the ones that didn't, weren't they in the pool?
well, and you know what, so they should be.
Yeah.
You know, I think they should be.
It's almost unprecedented where the Reserve Bank comes out and says, lower your damn loan, lower
Correct.
your damn rate.
That's right. And I think that's just a bit of chest banging.
Yeah.
But yeah, look, shop it around. Make the most of smaller lenders and sharper rates. And as I say, if you can reset your borrowing because you've got in front of your mortgage and reduce your payments, that can help use cash flow for super contributions, for other investment opportunities, and you can stack that extra cash flow on top of something else in the future to make the most of what you have. So I think they're all things that people need to think of. And as I say, if you don't ask, you don't get.
Well, how much wiggle room have you actually got when you go into a bank or into a financial institution? Yeah, how much can you negotiate? I mean, it's not like a market in New Delhi or something. You can't haggle that much.
We're not giving over street watches, exactly. Look, I'll give you an example. So I sent a loan for a client out to a mortgage broker this morning at a certain rate, and it came back 1.2% cheaper.
Really?
So
it does exist.
It really does exist, because loans and loan products are very similar to investments and investment products. They evolve, they change, and what you need may not be what you had or what you could get. So I recommend that people ask the question and get a loan product that is right for them. I liken super funds to cars. And I say, you don't need a Ferrari to deliver bread. Like most tradies have a ute, they don't have a two-door BMW. Because it's very hard to get all your tools in the back of a two-door BMW.
That's their second car.
That's right, that's their weekender. So loan products are very similar. You can pay for all the features and all the bells and whistles. But what do you need? And if not having those bells and whistles means that a broker could get you a better rate, you're tying together the money that you need to borrow at an interest rate that suits your situation at the time. So, there are deals out there that brokers can get hold of that you may not find online. And as I said, my bank's never rung me up and said, hey, we'd love you to pay less interest. So if you don't ask, you don't get. Get in and see a broker, get a loan that's structured right for you, and get your payments down and have something that you can benefit from over 2, 3, 4, 5 years, because it's worth a lot of money to you.
Look, there are brokers and there are brokers, and I know that it's well regulated, so there's quite a bit of protection there, but how do you pick a really good one?
Look, I think most things in life now comes from referrals. People go to a trusted source. People go and deal with people that have done a good job by them. And I'll only ever send a client to a broker that I know and I trust and I understand how they operate, so that I know anybody that I look after is going to be looked after by them. And I've got 2 or 3 key relationships that I have that I've built up over 5, 6, 7, 8, 9 years, because my client's protection is the most important thing to me. Because if I refer somebody to a third party, I'm responsible for that in my eyes. So I'm not going to jeopardise my relationship with a client that I may have had for 2, 3, 4, 5, 10 years by sending them to someone that I don't know, does a great job and has a like-minded approach to service, to functionality, and to attaining an outcome for a client. So, we use Trilogy Funding in Deakin. They do a top shelf job, and I know that Dave and the team in there will give people the truth, the whole truth, and nothing but the truth. We also use more mortgage options in the city. Now, there's a family-based business that has been built off dad creating a product, and then the 2 boys and a sister having those philosophies. So go to somewhere that you can trust, go where someone's had a good experience, and ask for recommendations.
Okay, where do we get more information? We'll have to do this very quickly.
Yeah, look, it's again
so fast when you're having fun.
Especially on a Friday. Look, you can go to the website, www.envisionfinancial.com.au. Go to the resource section there. We've got the knowledge centre. They've got calculators in there you can use to see, well, what is it worth for me to change? We've got a whole range of things people can use to try and see that value and look into the difference between fixed and variable rates. YouTube, Envision Financial Canberra. We've got all the shows on there with the key points and takeouts from previous episodes, and obviously the podcast on Apple. Search the Strategy Stacker, where I talk money, and obviously we have the podcast from today and other shows, so that people can stop it, listen to it, and take what they need.
Good on you, Luke. Good to talk to you. We'll catch up next Friday.
We'll see you next Friday. Beautiful. Thanks, mate.
Luke Smith from Envision.